Peter Lynch, How to Invest for Beginners. In case you haven't heard of Peter Lynch, this American-born investor, mutual financial advisor, and philanthropist was born in 1944. Lynch authored the best-selling financial books One Up on Wall Street and Beating the Street. As an operator of Fidelity's Magellan Fund, Lynch produced an annualized return of 29% between 1977 and 1990. Over 13 years, he outperformed the S&P 500 by more than twice as much, making the Magellan Fund the best-performing mutual fund in the world. In just 13 years, it went from managing $18 million to $14 billion. In today's video, we'd like to pass on some of Peter Lynch's most valuable advice for investors. Refrain from making an uninformed purchase. According to Lynch, our eyes, ears, and common sense are the three most valuable instruments for researching the stock market. Lynch was pleased that many of his excellent stock ideas came to him while going about daily activities, like shopping or having casual conversations with his friends and family. When we watch television, read the newspaper, or listen to the radio, these activities allow us to engage in first-hand analysis. When doing other things, such as driving down the street or going on vacation, we may also think of new ways to invest our money. Ultimately, consumers are responsible for 2/3 of the total gross domestic product generated in the United States. In other words, most financial markets serve you as the individual consumer. Therefore, if something appeals to you as a consumer, it should equally spark your interest as an investment opportunity. Do your homework every time. Practical information and first-hand observations can be very helpful in getting started, but in the end, every excellent concept needs to be backed up with solid research. Do not be misled by Peter Lynch's apparent homey simplicity when conducting thorough research. Peter Lynch's success was built on a foundation of meticulous investigation. As a follow-up to the initial glimmer of a fantastic idea, Lynch emphasizes many fundamental qualities that he expected to exist for any stock that would be worth purchasing. If you're enjoying this video so far, please hit the like button and subscribe to our channel if you haven't yet, to show us your support. Now, let's continue. The proportion of total sales. If a product or service initially drew you to the company, you should make sure that it comprises a high enough percentage of sales to be meaningful. A ratio of PEG. It is important to look at the price-to-earnings growth rate ratio to determine the level of anticipation that is now built into the company. It would help to look for companies with strong earnings growth and reasonable valuations. A powerful grower with a PEG ratio of 2 or even more has that profit growth already founded in the stock price and has left little room for error. Favor corporations with healthy cash holdings and debt-to-equity ratios below the average. The corporation has alternatives available to it in all different market scenarios because of its robust cash flow and careful asset management. Consider the long term when investing. A statement by Lynch to this effect: over a decade to 2 decades, the performance of stocks is usually predictable, barring several unexpected events. You might as well toss a coin to see if they will be higher or lower in 2 or 3 years. The fact that these statements came from a Wall Street icon demonstrates how deeply he believed in his views, even if they appear out of character. Lynch stayed up to date on the firms he had, and if he didn't see any reason to sell, he didn't. Lynch didn't try to guess the stock market's future or the economy's fate. Lynch once researched the viability of market timing as a tactic. The research found that an investor who put away $1,000 per year on the peak trading day between 1965 and 1995 would have seen a compounded return of 10.6% over the whole 30-year period. The same 11.7% compounded return would be earned over 30 years by another investor who invested $1,000 per year on the same period's lowest day of the year. Even after 30 years of terrible market timing, the first investor only fell behind by 1.1% per year. Lynch concluded that spending time to foresee the short-term changes in the market is not worthwhile. If the business does well, it will generate higher profits, increasing the stock price. By keeping things basic, Lynch could direct his energy toward the most crucial part of his job: identifying profitable businesses. The phrase 10-bagger, first used to denote a stock that increases in value by 100%, was first used by Lynch. The stocks above are what he sought out while managing the Magellan Fund. The first rule of funding, a 10-bagger, is never to sell the stock after it has increased in value by 40% or 100%. These days, many money managers try to reduce or sell their winning stocks while increasing their losing ones. That was like, in Peter Lynch's words, picking the flowers and watering the weeds, he said. Peter Lynch's success and stock-picking ability are undeniable, even though he took the risk of over-diversifying his fund. He mastered the art of observation, coming to terms with the world and imagining how it might be different in the future. By implementing his ideas and our observations, we may learn more about investment while engaging with our world, making it capable of investing more pleasurably and successfully. Well, that's all for today's video. Tell us in the comment section how this one was. I hope that you found this video interesting. If you want to see more videos like this, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories. And until then, stay tuned.